Canadians have been sold the idea that buying a home is the best way to build wealth. And at first blush, it's tough to argue with the numbers. If you bought a home in Vancouver or Toronto back in 2005, you would have tripled your money and you'd probably be feeling pretty good about yourself today. But now look at this. If you had invested in the S&P 500 index instead, your money would have risen sixfold in that same time, and suddenly you might be second guessing your home buying decision. So what's actually the smarter move? To buy a home or rent and invest instead? Well, the answer may shock you. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, your guide to leveling up your investing skills with perspective from savvy DIY investors and financial pros. I'm your host, Rob Moise, and I'm really excited for today's episode because we're challenging one of the most pervasive myths in Canadian finance, that buying a home is always the right financial move. It turns out the truth is not quite so simple, as we'll soon see. Joining us to help bust this myth is Ben Felix, Chief Investment Officer at PWL Capital. He shares investing insights to more than 500,000 subscribers on YouTube, and he also co-hosts the Rational Reminder podcast each week. Ben, it's great to have you back on the program with us. Thanks for taking the time to chat.
Great to be here. Thanks for the invitation.
You are definitely the man for the moment, Ben, when it comes to this topic, because you and the team at PWL, you ran an analysis to basically put some hard numbers behind this buy versus rent and invest question. I'm curious, what inspired you guys to crunch the numbers in the first place?
Oh, listen, I've been interested in this topic since I was just out of university and wondering myself whether I should be hoping to buy a home or continue to rent. So we started crunching the numbers back then. And this most recent analysis was really an attempt to, rather than using assumptions to build a model comparing renting and owning, we wanted to use actual historical data to make the comparison. So that's really what we've done here is taken pretty robust historical data, I think, and applied it to a rent versus own model to measure the outcomes of renting and owning.
I mean, the question is obviously a very emotionally charged one for a lot of people. People are either on like one side of the spectrum or the other here. I think one of the things that sort of gets lost in the conversation for a lot of folks is all the hidden costs of home ownership that make the debate actually a lot closer than a lot of people might assume. I'm wondering if you can just kind of take us through some of those hidden factors and maybe quantify them a little bit for us.
Yeah, so I mean, rent has this reputation for being throwing money away, which is something that I've never really agreed with. I mean, first of all, when you rent a place, you're paying for a place to live, so you're not throwing money away just in that sense. But the other thing that I think is really important and is often missed is that homeowners have similarly what I would call unrecoverable costs. So you pay rent, you get a place to live, as I said, you don't have a residual value though, which is why people think of rent as throwing your money away. When you own a home, you similarly have unrecoverable costs. You've got property taxes, you've got maintenance and depreciation. And the big one that people often don't think about is you've got the opportunity cost of tying up your equity in a home instead of investing it elsewhere, like in the stock market. And so that one I mentioned tends to be quite large. If you think about the expected returns on stocks, which is something you could very easily invest in instead of having home equity, by our estimates, it's reasonable to believe that the difference in expected returns between stocks and a home is around 3% a year. And that comes from a 4% real return for equities or for a diversified portfolio, potentially even of stocks and bonds at that level of expected return, versus around a 1% adjusted for inflation return for real estate. And that is a historically grounded number for Canada and other countries around the world. So I've always said that that's pretty reasonable. But again, that's one of those figures that I used to use as an assumption. And in this more recent analysis, we've used actual historical real estate returns. Yeah.
I think a lot of people forget that, yes, Canadian real estate was rip-roaring for several years there, but that was like a big historical anomaly. Like that 1% real appreciation figure is probably quite eye-opening to a lot of people. But yes, all the hidden costs are definitely a big factor. You know, another thing too that I think gets sort of underappreciated is some of the benefits of renting. I think a lot of young Canadians might sort of jump to the conclusion that, at least with home ownership, I get an asset out of the end of it, but you get a lot of lifestyle flexibility. Maybe take us through some of these underappreciated benefits of renting.
Yeah. Real quick, just on rent being throwing your money away, and I know we'll talk more about this later, but The homeowner does get a residual value in their home. Like that's why it has that perception. The renter, though, and again, we will get into more detail on this later. The renter typically has lower overall costs than the owner, and so they are able to build equity by saving that difference into a portfolio of stocks and bonds or stocks or whatever. Anyway, so it's just, you think about long term, the homeowner, yes, they have a home, but the renter, if you properly model this, which is what we're going to talk about, I think they do end up with a residual value, or at least they can. Okay, so renting can be really, really great because it gives you a lot more flexibility. You've got less responsibility. You're not I mean, I own a home right now, and it's a lot of responsibility. It's a lot of work. Your expenses as a renter tend to be more predictable. You kind of know how much your rent is going to be each month. Now, I understand rents can increase if you're not in a rent-controlled area. That's something else to think about. But generally speaking, you're not going to have a $30,000 expense pop up because something happened to your roof, which is something that can happen to a homeowner fairly easily. You're not taking the same kind of market price risk that an owner is. When you own a home, you have exposure to this one big risky asset. And people often think that homes are safe. When you look at a real estate index, it tends to be a little bit less volatile, or often quite a bit less volatile than the stock market. But when you look at individual homes, which is something we don't tend to have very good data on, but studies that have looked at this show that individual homes are about as risky as the stock market in terms of the volatility of their prices. So you're not taking that risk on as a renter. You're not taking on a big chunk of debt. Mortgages can be stressful for people sometimes. They also increase the risk of the asset, as I just mentioned. And a big thing is that when you rent, you can have a more diversified portfolio. So a renter who invests in the stock market, yes, they're still taking risk, but they're able to invest in, unlike a house, you can invest in thousands of stocks. You can't invest in thousands of houses when you're a homeowner.
I think for me, someone who used to rent as well, the biggest thing out of all those things that you listed was all the unexpected maintenance. Okay, I am not a handy person, and I hate doing all these things, and they always seem to crop up at the worst possible times. I miss having someone else dealing with all of that. It's the little things I feel like can make the biggest difference. That said, listen, good to kind of lay the framework here of the renting versus buying conversation, because, busting some of those misconceptions. But now let's get into the surprising findings of your study. Maybe help settle this debate a little bit more firmly. Is it better to rent and invest or buy a home in Canada? For those in our audience, if you want to get in on this conversation, and I'm sure you do because it's a hot button topic, we want to hear from you. Make sure you submit your questions to us. If you're watching on Webbroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, it's the questions and comments box. And if you're watching on our YouTube live stream, there's a link in the description you can follow to take yourself over to the broadcast platform and ask your questions there. Okay, Ben, so before we dig into the findings of the study, I think we got to lay a little bit of groundwork in terms of the assumptions that you used, the parameters that you had for this study, because obviously that's a big factor in the outcome of the study. So take us through some of the highlights of the parameters and assumptions you used to build this thing.
I will do that for sure. I do want to mention real quick, I just mentioned a lot of benefits of renting, which are all true. I think that there's also significant benefits of ownership, and that does show up in the study. So I do just want to mention, when you own, you are hedging the cost of living in a specific home. So we've heard about a lot of people in Toronto in particular being rent evicted or priced out of their unit. And that, when you own, that's just not something that really happens. So if you want to stay in one place for a very long time, I do think that owning is a very interesting option relative to renting, where it's much easier to get evicted or priced out of that unit. There are also some behavioral considerations, like when you have a mortgage payment, you're going to make your mortgage payment. When you rent and say you're going to invest the difference, it's a lot easier to skip out on a month of savings or even a year of savings. And then another big one, and I don't really account for this in my model, and I'll explain why, is the primary residence tax exemption. So I model a tax-free renter, which assumes that they're using an RSP, TFSA, or FHSA, which, for reasons we can talk about, I think is a good assumption for many, if not most people. However, for somebody who is a taxable investor and has a high tax rate, the primary residence tax exemption does make owning look better. And I can get into the details about how much better as we go through.
So talk to us a little bit then, just to kind of circle back to those parameters and assumptions that you built the study around, because I think those are important things to highlight.
Yeah, I'll just kind of walk through the way that I set it up. So I imagine a person in January 2005, and they're renting a place to live, paying the average apartment rent. And that's an important point. I do use apartment data just because it's much more readily available and much higher quality. It's hard to find rental data for single family homes, for example. But I think that the overall study and results are still representative. So you're renting a place to live. I'm looking at 12 different cities across Canada, the most populous cities across Canada. And so this renter who's renting in 2005, they have enough cash to make a 20% down payment to buy the average apartment in the city that they're living in and pay the closing costs. And they're sitting there and they're trying to decide, should I buy a place or should I keep renting and invest this cash that I've saved up in the stock market? And so then what the model does is it tracks the counterfactual outcomes through the net worth of the renter and owner scenario over time. So if you continue renting, this down payment and closing cost cash gets invested into the stock market. And then if you buy, it goes toward purchasing an apartment. And an important point is that the homeowner, so the person who decides to purchase, they have enough cash flow to cover the costs of owning. So that includes property taxes, maintenance costs, condo fees or strata fees, insurance, and the mortgage payment. So that is the amount of cash flow available in the model to both the homeowner and the renter. And that's important for a reason I'll explain in a second. The owner uses a 20% down payment on a 25-year amortization mortgage at the prevailing mortgage rate at the time. I believe it's 4.1% at the start of the sample period. They take a 5-year fixed mortgage, which renews every 5 years at the mortgage rate at that time. And they do pay 2% in closing costs. So the renter, as I mentioned, they have the exact same amount of cash flow available as the owner. But the big difference is they have typically, and in all of the cities in my model, they do have lower monthly cash flow costs than the owner because they're just paying rent and a lower amount typically for insurance. So the owner has all these expenses. They have the cash flow to cover them. The renter has the same cash flow available, but lower overall expenses. And the renter is taking the difference each month between their cash flow costs and the owner's, and they're investing them into an investment portfolio. Now, that assumption is one of the biggest assumptions in the model, and it's one of the assumptions people love to push back on, while the renter's not actually going to save the difference. That's a fair thing to point out, but I do want to talk a little bit more about that assumption. I agree that renters won't always save the difference. I think what's important about this model is that it shows that if someone can be a disciplined saver, they can still have a good financial outcome. Now, that being said, forced savings is a very good argument for buying a home. If someone's going to rent and spend instead of rent and save that difference, maybe you should buy a place to live just for the forced savings. And I think it's kind of a feature of mortgage debt too, where you get to borrow a bunch of money to buy an asset, and then you're kind of forced to pay it back, which really instills discipline. But if you can be a disciplined renter, then that argument doesn't hold a whole lot of water. One other important point is that the renter in the model is investing in a globally diversified stock portfolio. So they've got a portfolio of 30% Canadian equity index funds and 70% global equity index funds. They're paying a 0.25% fee, which is similar to VEQT, although the fee on VEQT has since come down. And as I mentioned earlier, we are investing in non-taxable accounts. So we're in the TFSA, FHSA, or RRSP as they became available throughout the model. And I did look at this. I asked, is that a reasonable assumption? And I just looked at how much a renter in this case would have been able to save, and it would have easily fit into the RRSP and then later the TFSA and FHSA. So I think it's a reasonable assumption unless you're a high net worth investor who's maxed out all of your accounts, in which case the numbers do change a little bit. One other important point is that, and this is part of using real historical data, rent in this model increases every year based on the actual rent increases in each city. So the overall annualized rent increases were over 6% per year on average, which is another thing that people often point out. So I do capture that in the model. And one other point on that is I do find in the highest rent growth cities, owning did look better, which speaks to another benefit of owning. I kind of alluded to it earlier. Owning hedges the cost of living in a specific home. So if you live in a city where rent prices just go crazy, if you own, there's a good chance that the value of your property is going up. So another way of saying that is that you are hedged against rising housing costs in that specific city, which can be a really good thing. What we've seen more recently is that hedges go both ways. If the cost of living in a certain city decreases, the price of homes will also tend to decrease.
Okay, so a lot of carefully calibrated parameters and assumptions here. I mean, this was not like slapdash. You really did the work to kind of come up with like as precise numbers as possible. With that said, who comes out on top in your study? Is it the homeowners or is it the renters? Take us through the highlights.
Well, so I looked at 12 cities. In 7 of the 12 cities, renters come out ahead. And then when I measured the outcomes as a renter to owner wealth ratio. So when that ratio is above 1, renters had come out ahead. And when it was below 1, owners had come out ahead. So in 7 of the 12 cities, I do find that renters come out ahead. And then when I take a geometric average of those ratios, the number that I get using my most recent update, which is as of 2025, year end 2025, the geometric average is 1.14 is the wealth ratio. So another way to say that is that on average across these most populous cities in Canada, there's a roughly 14% net worth advantage for someone who rented starting in 2005 and invested the cost difference between renting and owning over somebody who had instead bought. Now, you can see in the chart that's up on the screen there that there is a lot of dispersion. So there are cities where renters were way worse off, and there are some cities where renters were way better off. I think what's really interesting, the first time that I ran these numbers with year-end of 2024 data, I found the ending wealth ratio on average was 0.99, basically 1, which means you're indifferent on average. And now it's just slightly tilted in favor of renters because home prices have had a bit of a rough go on average in Canada over that year, while stocks did quite well. But in either case, we're talking about a pretty close difference, which is kind of what you'd expect in an efficient market. If either renting or owning were obviously much, much better financially, you'd expect people to kind of shift between the two until the price reached an equilibrium where you're roughly indifferent. And I think that's kind of what we're seeing on average across Canada.
I mean, I would say when I look at this data, you know, the 14% higher net worth that the renter has, I mean, that's not chump change. I mean, that sounds like a pretty decent, you know, increase over the homeowner. And particularly, hey, I'm biased because I live in the city of Toronto. 37% better net worth. I mean, that's a pretty big jump. So, I mean, like, if you were to boil it down into like a couple key factors, like what is ultimately the biggest levers on why you know, the renter comes out ahead or the homeowner is ahead? Like, could you boil it down to like a couple big factors?
You cut out for a second there. Was that in the whole study, or are you just looking for a couple
in the whole
cities?
study? Yeah, in the whole study.
Okay, so if I look across everything, there were a bunch of really interesting pieces that did affect the results. So I did look at fees, investment fees. If the renter's paying higher fees, it starts to look much worse for the renter, and that average renter to owner wealth ratio does drop quite a bit below 1. So I had the 0.25% fee in my baseline, and then if I drop this is using my 2024 data. I haven't run all this sensitivity for the 2025 data. So we're going from a 0.99 wealth ratio. If we increase the fee to 0.87%, which is the average fee on actively managed fee-based mutual funds and ETFs in Canada, that ending wealth ratio drops to 0.87. So you can see pretty quickly it looks a lot worse if you're paying high fees. Another big one was asset allocation. So I model in the base case a 100% equity portfolio. If we drop that down to 60% equity and 40% fixed income, so a typical balanced portfolio, that wealth ratio does again drop significantly. It goes from 0.99 to 0.68 under that specification. And one of the big ones, I mean, these are all things that you can control to some extent. Fees, asset allocation. This is the savings efficiency is the one that I think gets the most attention, where people say, well, renters are never going to save the difference. It turns out that matters a lot. So I had 100% what I called savings efficiency, which means, okay, we have this cost difference, this cash flow cost difference. We're going to assume the renter invests 100% of that. If we drop that just down to 90%, the ending wealth ratio goes from 0.99 to 0.89. And if we drop it to 80% savings efficiency, which is still pretty good, it drops to 0.79. So you really can see that savings assumption truly is very important. I also played around with maintenance and depreciation. So my base case was, it was around 2.7% in total maintenance and depreciation costs. Some people think that's too high, but like try owning a house for a while. You'll see that it's not that high.
You'll kill for 2.5%, you know?
Oh, I wish. But you start playing with that, you have much lower maintenance and depreciation, and owning can start to look a lot better. And if you have much higher, it can start to look a lot worse. Another really interesting one was the mortgage amortization and down payment. So I had a 25-year, 20% down mortgage. But if you take more leverage, owning can look better, even with CMHC. Although if you go really low, I did find that there's a bit of an inflection point where it starts to look worse. If you do 100%, if you buy cash, basically, owning looks a lot worse. So that does show that the leverage component of owned homes is an important part of their ability to generate wealth. That's another interesting one that I think is a little bit counterintuitive, where people think paying off mortgage debt is good. And for a lot of reasons it is. Like, I'm not saying people shouldn't want to pay down their mortgages, but the leverage that you get when you do take a mortgage out is financially quite beneficial, at least on expectation. So I did find that larger down payments made owning look quite a bit worse. Yeah, those are the big levers, I think, and they're all things that are, other than maintenance and depreciation, they're all things that are kind of in your control. And it leads me to think that, like, a smart renter that has low investment fees, takes the right amount of risk with their portfolio, saves, they have a high savings efficiency, they can do quite well relative to an owner.
But Ben, I gotta push back on that a little bit, in the sense that, based on what you know about DIY investors and your average Canadian investor, like, how likely is it that somebody is going to be able to follow the blueprint that you sort of laid out in the study here?
Well, you know what? So I did a paper on this. I've done some videos on it too, but I did a paper as well, and I do talk about this in the conclusion, that it's, here, I'll quote myself from the paper. To have a chance at matching the wealth of owners in our model, renters need to save 100% of the cost difference between renting and owning, invest in low-cost investment products, and capture market returns. These simple actions are at odds, to your point, Rob, with the behaviors of many investors, suggesting that homeownership may offer a more straightforward and accessible path to wealth accumulation. So I do stand by that. I think the findings of this study were very interesting for a lot of people, particularly the kind of financial nerds that like to follow my content. I think it's really useful information. But for the average person, I think owning is still very attractive, because it's just, you just buy a house and pay your mortgage down, and there's a pretty good chance you're going to be okay in the long run.
Okay, so there you have it, folks. Like, there's like the key takeaway, I guess, in a lot of respects. Like, if you're your everyday person, home ownership can still be a really great option, and you probably come out ahead. But if you're a savvy investing nerd who's super diligent and focused and consistent, it can be a really viable option. So it's something that shouldn't be dismissed out of hand. Ben, I want to circle back to something that you mentioned about putting down a larger down payment actually being, like, disadvantageous to the homeowner. That is extremely counterintuitive. It's making me second guess what I did in my case, frankly. Can you just, like, unpack that a little bit for us? Like, why would that be the case?
So borrowing money is a good thing. Another way to think about this is that when you put a bunch of equity into a home, the renter in this model, because we have to keep in mind, we're doing this apples to apples comparison where whatever the owner does affects what the renter does. So if say we're talking about $1 million home, if we're going to put a 20% down payment down, okay, there's a 20% down payment, there's a mortgage payment. If we're going to do a 50% down payment, that's now $500,000 that in the renter's case, they're going to go and invest. Now, the owner is going to have a smaller mortgage payment, which means that the cash flow cost difference is going to be smaller, and it could even be negative. But typically what I see in the modeling is that the renter's large initial investment into the stock market is sufficient to propel them ahead of the owner. Whereas if we start with a smaller down payment, the renter has less to invest to start with, and they're kind of incrementally adding to the portfolio over time. So I would say the big thing there is one of those unrecoverable costs of owning, which is the opportunity cost of equity, is much larger with a large down payment, and that's really what's driving the difference there.
I want to throw out a scenario because I think a lot of people fit the bill in this case. They can afford to buy a home and they can also continue to invest. I certainly fit into that category. So for somebody like that who can kind of do both, like, does it make sense to split the difference like that? Or should you focus on like doing one or the other?
Like paying down your mortgage or investing?
Yeah.
Oh, it depends what you want to do. That's a tough one. That's like how much you have in stocks versus bonds. You know, it's not a blanket type answer. The nice thing about paying down your mortgage is that you really increase your level of safety of being able to stay in that specific home. Like when you have a mortgage against a home, there's a risk that interest rates change materially. In Canada, we don't really have long-term fixed rate mortgages like they have in the US. And so it's possible, and we saw this around the whole pandemic era, where people's mortgage payments went kind of crazy. And so that can happen and affect your ability to stay in a specific home. So for that reason, paying down your mortgage reduces the risk of living in a specific home. If that's important to you, and I mean, paying down debt reduces your risk overall, even separate from attaching it to the real estate asset. If that's something that's important to you, then paying down the mortgage can be great. But there's an implied cost there, where if you're paying down your mortgage instead of investing in the stock market, there's a chance that you're leaving some money on the table. It can also get really interesting from a financial planning perspective, and this is something that we'll often talk to clients at PWL Capital about, where if you have the cash to pay down, say, a big lump sum on your mortgage, but you're actually comfortable with the debt, you can do something that we call a debt swap, where if you borrow money in Canada for the purpose of earning income or with the intention of earning income, the interest on that loan is tax deductible. If you borrow money to buy a primary residence, it's not tax deductible. So if you can pay off a big chunk of your mortgage and then re-borrow to invest, you can actually make the interest tax deductible, which can be kind of interesting. But anyway, this is a very personal decision. I think it really depends on your specific goals, preferences, risk tolerance, and your overall financial plan. So it's a tough one to answer as a blanket statement.
Yeah, and I think that's another really key takeaway for people to appreciate, that although we often fixate on things like home prices and my mortgage payment and the returns I'm going to get on my investments, a lot of this boils down to non-financial considerations and what your life goals are and stuff like that. Some people don't want to have a big chunk of debt hanging over their head, so maybe paying down the mortgage is right for them because it feels better and it de-risks them to some extent. So a lot of things to consider. But Ben, I really appreciate you taking us through the nuts and bolts of this study and the key findings. It's really fascinating stuff, and it's great to see some hard numbers actually put behind this contentious issue. We got a lot more to get to, but I want to take a quick pause in the action here because I have a little bit of fun, because the team at PWL, you guys created a very nifty rent versus buy calculator where you can kind of estimate what would be the better option for you, financially at least, renting and investing or buying. So naturally, I got curious about my own home buying decision, and boy, it doesn't look as good as I was hoping it would. We have a chart that we can put up here. Just for a little bit of context, my wife and I, we bought a modest 3-bed, 3-bath Toronto home for well under $1 million several years ago. Now, granted, this isn't backward looking to some extent, but I sort of plugged in the same kind of relevant assumptions that we had at the time, the down payment, the mortgage rate, amortization, all that good stuff, equivalent rental costs for a similar property. And I also selected the 100% stock portfolio because that's personally what I do, just like how you do in the study here. It turns out that I would be almost $2 million richer in 50 years if I had chosen to rent and invest instead, which is pretty grisly if you think about it. And I'm definitely not going to be showing this chart to my wife, I'll tell you that much. Ben, I'm curious why you think things get so out of hand here for the rent and invest, because it's so neck and neck pretty much right up until, I guess what would be my estimated retirement date. Where do things go awry for me, the homeowner?
Yeah, I mean, the amount of equity in the home is increasing over time, and so eventually you've got this big slug of equity, and you're comparing that to the growth on a higher expected return portfolio, and it's really just compounding over a long period of time. We see that divergence show up. That's really what's driving it. Ben, I'm curious, did you use this calculator at all, to look at what your decision was like? Did you crunch your numbers? Did you get morbidly curious or anything like that? Because you recently bought a home maybe a few years back too, right? You were a long-time renter. So, what did the calculator say to you if you were brave enough to plug in the numbers? So I didn't have this web-based calculator that we have now. Back then, we had a spreadsheet, and I had a pretty good handle on what the numbers looked like. So I did the quick math on, is this a ridiculously bad financial decision? And it wasn't. It was roughly neutral, maybe slightly advantageous at the time to buy for me based on the amount of rent that I was paying. So I did look at that, but I think a big thing for me is that it was not really a financially motivated decision. We moved during the pandemic. We were living in the city. We had 4 kids at the time, and it was just becoming too much to be kind of cooped up, not being able to go outside a whole lot, being sort of we were in a part of Otto that was just not great for being in the house all the time, and we wanted to get out of the city and move into the forest, which we did. There weren't a lot of rentals. I mean, we looked in the area that we wanted to move to, so we were kind of stuck on finding a place to buy, which we did. But I haven't spent too much time thinking about whether this was a bad financial decision or not, and I don't think it was. Well, that's not fair to say. Maybe like you, I could map it out and show that this is going to cost me a lot over the long term. I would not be surprised to see that. But all the benefits of owning, we're staying in one place. We're hedged against the costs of living in this area changing. Yeah, I mean, those are, I guess, the big ones in our case. And another one we haven't talked about is that the availability of rentals in certain places, in certain types of housing, is often really low. So I live in a pretty rural area, and the single-family home rental market where I live is basically non-existent. Even the townhome and condo rental market is pretty tight here. So there are some places or lifestyles where renting is just not an option. And I think this speaks to your earlier point, Rob, that crunching the numbers is important because you don't want to make a totally terrible financial decision. But at the same time, and I think my main takeaway from this research is that if we can show that financially it's basically a wash on expectation, you don't expect to be much better off as a renter or as an owner, then the decision should be made based on the non-financial factors, on the lifestyle factors. And so for me, that's really how we thought about it. But I kind of went into that decision knowing that the finances would be and should be roughly a wash.
I talked myself off the ledge by thinking about a lot of those non-financial issues and factors too. So I'm still feeling good as a homeowner. I just had to, go cry in a corner for a little bit, but feeling better about it now. But for those in the audience, if you want to crunch the numbers for yourself, PWL has this great calculator, like I mentioned. If you're watching on our broadcast platform, I actually included a link directly to it in the resources section, so you can check it out there. Otherwise, it's a quick Google search away. It's a lot of fun playing around with the numbers, I got to say. Ben, we're going to get to our live Q&A in just a little bit, but I just wanted to ask you some of the burning questions, I guess, that somebody who's a prospective homeowner might have. Because as we were discussing, it can still be obviously a really good decision for a lot of people. A lot of people might be looking at the market and saying, is now a good time to buy because we've seen property prices come off a little bit? I'm just curious, what's your take on that?
I don't think you can time the real estate market or the stock market. We're looking at these numbers now. You mentioned the 14% net worth difference between renters and owners on average not being chump change, which I agree with. But it's important to keep in mind that a year ago in the data, going year end 2024 instead of 2025, it was about a wash. So these things can change very, very quickly from year to year. So I think looking at current market conditions and saying, well, I think I'm going to do this or that, I don't know. That's probably not what I would be thinking about. It is true, though, that real estate prices in real terms, depending on how you crunch the numbers, but with some real estate indices and some ways of measuring inflation, this current real estate drawdown that we're in is it's either the worst or second worst real price decline in history. Well, at least going back to 1975, which is where the good quality data start. Does that mean it's a better time to buy than it was a couple of years ago? I mean, maybe, maybe it is. But I wouldn't be making that that decision from a market timing perspective. I'd be thinking about it still from the lifestyle. What's right for your family? What's right for you? Perspective.
Okay, so good kind of food for thought for those who might be getting fixated on price and stuff like that. It's try to think bigger picture about it. Another question that I know a lot of people have is, what's the best order to contribute to the various registered accounts that are out there when you're saving for a down payment specifically? Do you have an optimal order that, generally speaking, tends to work out best?
I mean, the FHSA is obviously fit for purpose if the goal is buying a home. I think the RSP Home Buyers Plan is also a very, very nice program. TFSA would be next in line, but it doesn't have the same sort of special features for the purpose of purchasing a home that the other two accounts have. The nice thing about the TFSA is that it's super flexible. Like, it's really easy to take the money back out if you decide you're not going to buy a house. But if you're pretty sure that you're going to be buying a home, it's tough to argue with the FHSA and then the RSP up to the home buyers plan amount. And then if you've maxed all of that out, then your last option is going to be a non-registered account. But the FHSA and RSP they're very nice programs for the purpose of buying a home.
Are there any variables that you think would change that order?
If your current taxable income is below what you expect your future taxable income to be, which you can't know, but I'll step back for a second. If we take the RRSP and the TFSA and compare them over a long period of time, if your current tax rate and your future tax rate are the same, the RRSP and TFSA are going to give you the same after-tax result. It's funny to think about, but when you do the math, that's just the way that it works. If your future tax rate is lower, which for a lot of reasons with the RRSP, it is probably going to be, the RRSP is going to give you an advantage over the TFSA. And if your future income tax rate is higher, the RRSP is going to be a little bit worse. The FHSA is a little bit different because when you put money in, you do get a deduction. When you take it out for the purpose of buying a home, you're not going to be taxed on the withdrawal. But if we're just thinking about RRSP and TFSA, if you're in a currently low income period of your life, the deduction that you get from contributing to the RRSP is not super interesting at the moment. And so in that case, maybe the TFSA would be better.
Okay, so again, great food for thought for somebody who's trying to plot out their path to a down payment. One last one for you. Do you think that there's an investing strategy that generally makes sense for young Canadians? I'm thinking in particular, saving for a down payment. Is there some sort of philosophical approach that's generally best?
This is a really tough one. So I personally, and I don't think anybody should do this. Personally, I was invested in stocks. And we were renting, and we were thinking we were going to be renting for a long time. And then, as I mentioned, we decided during the pandemic that we were going to move. And we had my wife and I talked about this, and we were like, well, we're probably going to buy a place. We're not really sure when or where, so we're not going to change anything. We kept our money invested in stocks. It ended up working out fine, but there's a world where it wouldn't have. So that was a risky thing to do. It's just what we did. There's an interesting point on this, actually, where in my model, I assume that the renter has the cash for a down payment. But a point that a lot of people have made to me is that in real life, if the renter had decided before they started saving for that down payment that they were going to continue renting, they probably would have invested in stocks, whereas the owner would have saved cash if they knew they were going to buy a house in the short term. And so that actually propels the renter even further ahead than the owner relative to what I found in my modeling. And I think that is a valid point. Investing in stocks is obviously super risky over any short period of time. You can lose money over 1, 3, 5, even 10 years investing in stocks. So if you know you're going to buy a house in the next year, 2 years, whatever, it's tough to say what you should be invested in. It's safe to say you should invest in cash, but you've also got an opportunity cost. So it's tough. It depends how certain you are about the timing of the home purchase goal, I think is a big thing that I would say. If it's uncertain and you're comfortable with a little bit of flexibility in actually achieving that goal and comfortable with a little bit of risk, then you can still be invested in risky assets. But if you're like, I'm buying a house in 2 years, that's just the way it's going to be, then you really can't take much risk with your investments. But this is one of those other things where it's really hard to say, everybody should do this.
Yeah, I think that's fantastic thought. I mean, and that actually kind of mirrors what we generally think about investing too. Like the longer time frame you have, the more risk you can take, and the shorter time frame, the less risk you can take. So it's interesting that like the same type of thing tracks regardless of whether it's for a home or not. So Ben, appreciate you addressing those questions. We're going to get to our live Q&A in just a moment, but to our viewers, if you're finding this really informative, you're having a good time listening to this, make sure you follow TD Direct Investing on YouTube, Instagram, and Facebook. You can scan the QR codes on screen to check us out. We've got a ton of content designed to help level up your investing knowledge, and you can also get sneak peeks at our upcoming live programs, including this program, by following us. So make sure you check it out. Okay, let's open the floor, take some questions from our viewers. Let's check out the first question coming to us. This one is from Aaliyah. When it comes to curbing inflation, which tends to be more effective? Is it stocks or is it housing? Ben, what does the data say about that?
Probably depends on the type of inflation you're worried about. As we've talked about, for the cost of housing specifically, homes tend to be really, really good. And that tends to be a big part of the inflation basket. Over long periods of time, and this isn't necessarily a hedge, but over long periods of time, stocks have higher expected returns, and so they do have a slightly better long-term outcome than real estate. But if we're talking specifically about hedging the cost of housing inflation, which is something that people making this decision should be thinking about, there's no question an owned home is much better as long as you're going to stay in that specific home. Well, one of the challenges can be that if you have a home and then switch to a different home, there can be a bit of a challenge there if you move to a housing market that is uncorrelated with your current housing market. So if you live in Toronto right now and decide you want to move to Vancouver, but Toronto real estate's down 25% and Vancouver's down 5%, then all of a sudden that hedge it turns into a risk.
Yeah, I mean, not to imagine all the transactional costs you're going to have to pay, too, to make that move that is going to eat into your money, too. Let's get to our next question. This one coming to us from Chris. Chris wants to know, if we experienced a crash like 2008, would that change your perspective?
I mean, these things are going to happen. If we were having this conversation in 2008, the data would look different, for sure. I mean, one of the reasons that I see the big difference from 2024 to 2025 is because real estate went down and stocks went up. But if we had a year where real estate went up and stocks went down, all of a sudden my numbers would change pretty significantly, pretty quickly. But it wouldn't change my overall perspective. I mean, even if we were in 2008 and we're looking forward to the future, I think you would say that, well, stocks actually have higher expected returns at that time, which may even make, on expectation, looking into the future, may make renting look that much better. Yeah, I think that building the fact that we will likely have crashes like that again in the future is a really, really important part of investing in the stock market. You have to be aware of that and be prepared for it in your overall financial plan.
Yeah, and it's in the same way that people cheer lower home prices because you get a deal. Well, the same thing on stocks, right, on an expected return basis. So that makes sense. Let's get to our next question. This one is coming to us from Michelle. Michelle is saying, is owning a condo or house with a renter to help cover the mortgage typically a smart strategy?
I'm assuming that means you're living in the house and having someone living with you?
Yeah, that's my assumption too.
Like?
Yeah.
Yeah, it's an interesting question. So there are a couple of things to think about there. One is that, well, okay, now you've got a roommate or a tenant. If you want that, that's okay, sure. But I think another thing to think about is that if we're making this a really apples to apples comparison, you've really got to be comparing the space that you are using. So you wouldn't be including the portion of the home that you're renting out when you compare it to your rental. And so what that's going to do is that the portion of the home that you live in that you are using is going to be compared to a much cheaper rental, because you're not going to rent a place that, has a roommate. Probably not. So I think when you think about it that way, and when you really do the apples to apples comparison, it's not going to make a huge difference. If we compare the cost of owning a home with a renter to the cost of renting the exact same home, another way to think about this is we could have a renter in both cases. Why doesn't the rental get a renter? It would depend on your lease agreement, I guess. Anyway, a bit of a tangent there, but I think the main point I have here is that when you have to make these comparisons on a true apples to apples basis. So I kind of like my last point, actually. If we're comparing a homeowner with a renter, we should probably compare the renter with a renter, or at least renting a much smaller place to account for the fact that the owner is not using their full home. But yeah, I think there are lots of interesting what-if scenarios that people come up with to say, well, maybe owning is better in this case. And typically, I think if you really think about it and make it an apples-to-apples comparison, there don't tend to be any sort of silver bullets that make owning look better.
It's amazing how even small changes in the assumptions that you use can greatly change the impact of what the finding is going to be. And so to your point about keeping things apples to apples as much as possible is a well one to take in mind. Let's take our next question. This one coming to us from Lorana. How much do interest rate changes affect each of these scenarios? Good question.
So in my modeling that we're talking about here, the historical modeling, I did have the interest rate changes that happened throughout history from 2005 to 2025. So those effects are baked in. If we think about starting interest rates, if interest rates are higher, it's kind of tough. If interest rates are higher, home prices might be lower and rents might be lower. So it's kind of tough to think about these things in isolation. But if we keep everything else the same and make interest rates higher, owning is going to look worse. But it's hard to say that, okay, we're going to jack up interest rates in our model and everything else is going to stay the same. That's probably not reality. We're probably going to see a whole bunch of other stuff change. But to answer the question, if we keep everything else the same and increase interest rates, well, then the cost of borrowing, the cost of the mortgage is going to go up. The mortgage payment is going to go up. The renter's expected return might go up, and it's going to generally just make owning look worse.
Mm-hmm. Okay, let's get to our next question from Justin. Justin's got a question coming to us saying, if you've built up equity in your home, does it make sense to tap into a HELOC to invest in the market? Very savvy thinking, at least here, Justin. I can see the thought process, but Ben, what do you have to say about that?
Yeah, that's a good one. I mean, if you do have equity and you want to borrow against your home, it's kind of like we talked about earlier with paying down the mortgage. If you want to pay down, if you don't want to pay down your mortgage because you want to be able to invest in the stock market, and in this case, we are talking about borrowing against the home to invest, so the interest would be tax deductible. It can make a lot of sense. I mean, listen, leverage has a place in some cases. We're very, very careful and conservative about how we use it and recommend it at PWL, but it can have a place. I mean, there's lots of academic work supporting the use of leverage in a lot of cases, but you've got to be very, very careful. And HELOCs especially, they can be callable, which means the lender can come back and say, okay, you've got to pay this back now. And they would typically do that when things are not going well in the world. And so you might have a portfolio that has declined in value and the bank is coming and saying, time to pay back the loan. Could be not so fun. You can use a traditional mortgage to do the same thing, but I would have the same comments. Like, listen, it's risky. Borrowing to invest is undoubtedly risky. It can have a place, but you've got to approach it very, very cautiously and really think through what you're doing, both from a financial perspective, in the context of financial planning, from a risk perspective, and then also from a tax perspective to make sure everything's set up the right way.
I think the emotions are a big part of it too when we talk about leverage, because we don't exist on paper. Humans are emotional creatures, and you can easily make a rash decision if something goes a little bit out of favor rather than sticking with the plan if you're using leverage. So certainly something that you want to be careful about if you're considering doing that. Let's get to our next question. This one coming to us from Mike. For retirees looking to downsize, is it better to buy a smaller condo or rent and invest the money from selling their current home?
Yeah, it's similar to what we've been talking about. An interesting point for retirees is that when you own a home, you're receiving an implicit dividend that's equal to the cost of living in that home. We haven't really talked about that, but it's part of the overall equation. But the interesting thing is that it's not a taxable dividend. So that when you live in an owned home, you're getting this benefit, this housing benefit, but it's not taxable. And then of course the asset is not taxable either. If you're going to be renting and aggressively drawing down your RSPs to pay rent, for example, then owning can start to look pretty good. But it's really going to depend on the specific financial plan that we're talking about. If we just think about another one is the hedging the cost of housing. It's a lot of retirees worry about being booted out of the place that they live in. A younger person might have an easier time getting up and moving, whereas older folks might find that less palatable. So there are lots of good reasons to own, but I think the same math that we've been talking about applies for a retiree as it does for anybody else, where there is a set of assumptions where you're financially indifferent between renting and owning, and it's really just a matter of running those numbers for your specific situation. But we have lots of clients at PWL who are retired and rent, and they're perfectly happy and perfectly fine. We have lots of retired clients who own, same deal. So it's really just thinking through thinking through all these points for your specific situation, running the modeling for your specific situation.
Now, granted, I'm like a far away from retirement, but I would think that the emotional aspect and the lower risk approach would probably be the one that would appeal most to retirees who are really just looking to, preserve their wealth and preserve their situation rather than, trying to squeeze out a few more % of return or something like that. I mean, that would just be my assumption. We'll see what I'm thinking when I get there. I don't know, but I got a long way to go. In any case.
I've got one more point on that one, if I may, Rob. We had talked about earlier the asset allocation piece. If a retiree is not comfortable taking much risk with their portfolio, remember I'm using equity as the baseline in my model. If they're instead in a 40% or 50 or 60% stock portfolio with the rest in fixed income, their expected return goes down a lot. Mm-hmm. And so in that case, renting starts to look worse relatively than owning. So that's just another consideration. Now, some retirees could be in all equity portfolios, and there is some research supporting that idea, which I think we've actually talked about that on your show in the past. But yeah, again, it's really going to come down to the specifics of the case.
Well, Ben, we really appreciate you fielding all these fantastic questions that we had from the audience. I thought there were some great ones in there. That's all the time we have, though. Really appreciate you sharing your perspective on this really contentious debate that there is. It's fantastic to have the data behind it. I think it turned a lot of heads, frankly, and opened some minds to the options that are out there. So a pleasure to speak with you as always. Hope to have you on the show again soon.
Appreciate it, Rob. Thank you.
And for those in our audience, of course, thank you for tuning in and thank you for your great questions. Make sure you check out next week's episode. We're keeping the home owning theme alive here. We got a pair of DIY investors who are going to explain how they were able to afford their first homes in their mid-20s. And no, it did not involve a generous contribution from the bank of mom and dad. We're going to hear how they did it and their top tips for other young Canadians looking to do the same. That's all the time we have on this edition of the show. But before we go, a quick note on keeping your accounts safe.
Fraud prevention isn't just about your digital settings. It's about the simple habits you practice every day while you're out in the world. Avoid public Wi-Fi for logging into your accounts when possible, but when unavoidable, use a privacy screen and always log out, especially on public computers. And watch out for the unsolicited call. If someone claims to be from TD and asks for sensitive info, hang up. Instead, call us directly through the call button in the TD mobile app. It authenticates you automatically, so you're knowing you're talking to a real representative, not a scammer. Stay alert and stay safe.
Some fantastic tips there to consider. Stay safe out there, everyone. From everyone at Inside Investing, thanks again for watching. We'll see you all next time.